Hi, everyone. Marty Becker here, owner and founder of Atlas Financial Strategies, where we specialize in asset-based long-term care insurance, guaranteed retirement income, and asset protection. So today in this short video, we're going to answer the question, is it better to invest my money somewhere else and self-insure? So this is going to be one of the most in-depth videos of this series, because we're going to verify everything based on math. An early mentor of mine told me there are no deals on the insurance industry. Everything is based on math. So let's start with the true cost of long-term care insurance, which is opportunity cost. Meaning, could you invest this money somewhere else and get a better return? And the answer is yes, you could. And the reason that is that this is not an investment. It's insurance, okay? We're not going to use this money to make more money. We are using this money to protect all of your other money in the event you end up in a long-term care situation. And remember how many people need long-term care at some point in their lives, okay? According to longtermcare.gov, 70% of people. So what we're trying to do is create the most leverage for every dollar you dedicate to your long-term care. Meaning for every dollar that we park with the insurance company, how much more will they give us for that dollar for long-term care? So let's just take a look at some real numbers here. This is an indemnity policy for a 65-year-old male with a standard non-tobacco rating. Keep in mind, there are many options and strategies to use, but we're going to use a simple one for this video. What he did was park a lump sum of $100,000, and then there's no premiums after that. What we're looking at here are the guaranteed values of what he will get, meaning no guesswork, no other growth. So we know for sure what this will pay him at any given point in the future. We also set this up for the benefit to pay up to 6 years, and there's a 3% compounding inflation rider on it, since we know things are going to get more expensive as time goes on. So with this particular policy, we went for maximum long-term care coverage. Again, there are no deals in the insurance industry. And because we went for max benefits, that means we also had the least amount of surrender value that he could get back if he changed his mind, which obviously we don't want to put someone in that position. We need to make sure that this is the purpose of the money. So we verified this was the purpose of this money for him, and that he had plenty of other liquid assets outside the policy for other needs and emergencies. We're always going to take that into consideration, that you have plenty of other money outside of a policy. But look what happens right out of the gate if he dies the very same day his policy is issued. His beneficiaries would get $124,000 in death benefit. And look what happens if he were to need that long-term care benefit the day the policy is issued. The insurance company would pay him over $5,100 per month for 6 years. And then they would continue to increase that by a 3% compounding rate for a total benefit of over $400,000. That's over a 90% internal rate of return. Now, internal rate of return, or IR, is not a calculation that most people are familiar with. What internal rate of return measures is the amount of return you must get every single year to match the return of the compared benefit. So let's just take a look at a more reasonable example here. Same policy here, but most claims are going to happen in someone's mid-80s, okay? If this gentleman were to park the same $100,000 that we talked about, lump sum, with this company, at 85 years old, you can see that his death benefit is still a little over $124,000, and his liquidity is just over the $100,000. Now, again, this is where the subject of opportunity costs come in, because I can already hear someone saying, oh my gosh, he's had that money sitting there for 20 years and it's still worth the same amount that he put in there. So again, the question is, would he have gotten a better return if he invested the money somewhere else? Almost without question, yes, he would have got a better return somewhere else. But remember, this is not an investment. It's insurance, and a very specific type of insurance. The purpose of this money is to pay for long-term care if or when he needs it. And at this point, at age 85, his long-term care benefit has grown to over $9,300 per month, or a total payout of over $726,000. So now the question is, what type of return would he have needed to turn that $100,000 into $726,000? I like this particular company because they actually list the internal rate of return right on the illustration, which is over 9%. That is the interest rate that he would have needed to earn every year on the original $100,000 in order to pay him $726,000 over a 6-year period before he ran out of money. So I know that's a little bit confusing, but let's break it down on a financial calculator to give you a little bit more of a visual here. Okay, so here's an easier way to verify this math. We take the cash flow calculator and we put our $100,000 in at age 65, okay? Then we just turn on what the payments would be, meaning what the insurance company would pay him at age 85. Remember, it was a little over $9,500 a month. If he just had this money sitting in cash, he would have burned through it in a year. So the internal rate of return on the illustration was 9.02, I believe, something like that. Pretty close. Sometimes once you add in the decimal points of the change, it changes just a little bit. So a little over 9.2% is what he would have to get every single year in another investment to match the payout benefit of the long-term care policy. But here's something else we have to take into consideration. If you were to invest the money somewhere else and try to match this benefit, what other things would we be paying for at that point? Management fees, for one. So let's just say between the management fee and an internal fund fee or something like that, the hidden cost that they put in there of 1.5%. I think that's being reasonable. Now, the 9.2% return isn't going to cut it. So I did the math before we started. Keep this short. We would have to get 11% return every single year with no down years once we factor in a management fee in a different investment. What else? Let's just say we're working with non-qualified money and maybe you're paying taxes on the return every year at a 20% tax bracket. Now, the 11% return isn't even going to be enough to match the policy benefit. I did the math again, keep this short and concise. If we factor in management fees and taxes, you would have to get over a 13% return every single year with no down years to match the exact same payout benefit of the long-term care policy. I think we both know that's never going to happen. Okay, so just to recap on what we talked about, and I hope you go back and you watch this video numerous times, especially that calculator portion. I know it's a lot to absorb in one sitting. But again, just to recap what we went through, this is not an investment. So please don't treat it like that or try to compare it to that, because we did the comparisons and realistically, you're never going to be able to match it anyway. It's not an investment. This is insurance. And the point of insurance is to pass risk to the insurance company. And even more so with long-term care policies, it's to create leverage for every dollar that we park with the insurance company. The only way to compare these to an actual investment is using a calculation known as internal rate of return. And based on these actuarial calculations, you just saw the type of returns you would need to get on a guaranteed basis to self-fund your long-term care. So going back to the original question, would I be better off investing the money and self-insuring? I guess the answer is, if you have an advisor who tells you he can get you a 13% return and he's going to put it in writing and sign it, I guess you have something to think about. But something tells me that's never going to happen. So anyway, I hope this video put some things into perspective for you, and I want to thank you for taking the time to watch it and absorb everything that we went through here. Also, I want to highly encourage you to watch the rest of this video series and then take the time to book a short phone call at atlasannuity.com so we can design your customized strategy. Again, this is Marty Becker, wishing you all the best.